Welcome back to our channel, where we explore the world of finance and investing. In today's video, we'll be discussing how bonds are traded on spread. Understanding bond spreads is essential for investors looking to navigate the bond market effectively. So, let's dive in. In the context of bond trading, a spread refers to the difference in yield between two bonds. It represents the additional compensation an investor demands for taking on the risks associated with a particular bond compared to another bond. There are two main types of bond spreads: yield spreads and credit spreads. Let's start with yield spreads. Yield spreads are used to compare the yields of two bonds with similar characteristics but different maturities. The most common yield spread is the yield curve spread, which compares the yields of government bonds with different maturities, such as the difference between the 10-year and 2-year Treasury yields. A positive yield spread indicates a normal yield curve, while a negative spread signals an inverted yield curve. Now, let's move on to credit spreads. Credit spreads measure the additional yield demanded by investors for taking on credit risk, which is the risk of default by the bond issuer. Credit spreads are typically measured as the difference between the yield of a corporate bond and a risk-free government bond with a similar maturity. Trading bonds on spread involves taking advantage of the price differentials between bonds with similar characteristics but different spreads. Investors aim to profit from the narrowing or widening of spreads over time. The process of trading bonds on spread usually involves a few steps. First, an investor identifies two bonds with similar characteristics, such as maturity and credit rating, but with different spreads. Then, they establish a spread position by simultaneously buying one bond and selling the other. Managing spread trades requires monitoring the movement of spreads and taking appropriate actions. If an investor expects the spread to narrow, they might buy the bond with the higher spread and sell the bond with the lower spread, with the aim of profiting from the convergence of spreads. Conversely, if they expect the spread to widen, they might take the opposite approach. And there you have it. An overview of how bonds are traded on spread. Understanding bond spreads is crucial for investors looking to capitalize on price differentials and manage their risk exposure in the bond market. If you found this video helpful, be sure to give it a thumbs up and subscribe to our channel for more valuable insights on finance and investing. Thank you for watching, and until next time, happy trading!